Producers have a fiduciary duty to their clients as well as their insurance company, and must always act ethically and professionally when selling life insurance and annuities. Solicitation and sales presentations. Producers have both express and implied authority to solicit insurance sales for the insurance companies they represent. This includes meeting with prospective customers and making sales presentations. Life insurance policy cost comparison methods. During the buying process, applicants may ask for a comparison between 2 or more life insurance policies. The most effective way to do this is with a cost index, which uses actual and future premiums and benefit amounts to compare the costs of similar policies. These are complicated calculations, and most insurers give their producers the resources necessary to support cost comparison requests. Fortunately, licensed candidates will not have to do these calculations on state exams. The 2 most commonly used indexes are: traditional net cost method shows the net amount to be paid for the pure insurance protection of both policies during the comparison period, without accounting for a policy's cash value and policy dividends. Interest-adjusted net cost method shows the real cost of owning each policy during the comparison period by accounting for each policy's projected cash value and policy dividends. Because it accounts for the cash value and policy dividends, the interest-adjusted net cost method is most commonly used today to compare permanent life policies. Policy replacement. When contemplating the purchase of a life insurance policy or annuity, applicants may consider canceling similar policies they already own. While there may be times when it is in the customer's best interest to replace a policy, there are plenty of times it is not. Replacement occurs when an applicant buys a new life insurance policy or annuity and, at the same time, an existing life insurance policy or annuity is lapsed, surrendered, forfeited, terminated, or otherwise compromised. Converted to reduced paid-up insurance. Continued as extended term insurance. Reduced in value using non-forfeiture benefits or other policy values. Amended with a reduction in benefits or term of coverage. Reissued with a reduced cash value. Key point: replacement is not illegal. Convincing a prospective customer to replace an existing policy through any sort of misrepresentation is illegal. Sometimes replacement is in the applicant's best interest, especially if the existing policy no longer meets the insured's needs. However, there are potential negative consequences of replacing a life insurance policy that include: the applicant must give new evidence of insurability. The new policy may have terms that are less favorable to the insured than those of the existing policy. The applicant will need to satisfy a new contestability period, usually 2 years from the effective date of coverage. The new life insurance policy may not have a current cash value. The new life insurance or annuity contracts may impose a new surrender period. Producer's duties in a replacement. Producers are expected to determine the suitability of every insurance transaction, based on a careful analysis of the prospective customer's needs. This is especially true when it comes to policy replacement. To make sure producers know if their customers intend to replace a policy, they are required to obtain a signed statement from every applicant declaring if the new life insurance policy or annuity will replace an existing, similar, policy. This statement is submitted with the application to the insurer. In cases where replacement is involved, the producer must also list all existing life insurance policies or annuity contracts that will be replaced. Give the applicant a comparison statement signed by the producer. Give the applicant a notice to applicants regarding replacement of life insurance or annuity. All states require the producer and insurer to act only in the best interests of the applicant. Both the producer and the applicant must sign a form indicating that the required disclosures have been made and that the applicant understands the consequences of the replacement. Copies of all forms used in the transaction must be left with the applicant. Insurer's duties in a replacement. A replacing insurer is required to notify the insurer whose policy is about to be replaced about the pending transaction. This gives the existing insurer an opportunity to preserve, the policy. If the existing insurer requests them, the replacing insurer must provide copies of any policy cost comparisons and proposals used in the transaction. States typically require the replacing insurer to maintain records of each replacement transaction for 3 to 5 years or until the next regular examination by the insurance department. Required disclosures. The Health Insurance Portability and Accountability Act of 1996, HIPAA, imposed strict requirements on those who collect, transfer, and exchange health and medical information about consumers. Insurers are subject to HIPAA's privacy requirements because they collect and use this information from applicants and insureds. The insurer has a duty to notify the applicant of his or her right to privacy and to give the applicant a chance to either consent to the disclosure or to refuse the sharing of this information with other parties. Notice of information practices. Producers are required to inform consumers about the practices their companies use during the review and underwriting process. Information disclosure typically includes giving the applicant a notice of information practices statement. It explains in writing that the insurer may seek information from sources other than the application to get details about the proposed insured. National Do Not Call Registry. The National Do Not Call Registry contains telephone numbers that consumers have registered to limit the telemarketing calls they receive. The Federal Trade Commission, FTC, Federal Communications Commission, FCC, and state governments regulate and enforce the registry. When a consumer registers a telephone number, businesses have up to 31 days after the date of registration in which to stop calling that number. Certain types of sales calls are still permitted. These include calls from businesses that have the consumer's express written permission and calls from businesses with whom the consumer has a business relationship. Field underwriting. While insurance companies rely primarily on their underwriters to determine if an applicant is insurable, the underwriting process begins with the producer and is called field underwriting. Field underwriting includes requesting information about prospective insureds and helping people fill out applications for coverage. The producer is responsible for collecting the right data to help the insurer decide whether to accept the application. The producer is also responsible for disclosing information to the applicant about the insurer's underwriting and policy issue practices. Application procedures. The application for insurance is the insurance company's single most important source of information about the proposed insured. It is filled out by the producer and the applicant. Part 1 of the application contains the applicant's personal information, including name, address, date of birth, occupation, and beneficiary information. Part 2 covers the applicant's medical history. Equally important is the agent's report, completed by the producer, which tells the underwriters what the producer knows about the applicant. A life insurance policy is a contract between the policy owner and the insurer, and the application is a physical part of it. Accordingly, the producer must do everything possible to make sure that the application is complete and accurate. Backdating the application. With every year a person waits to buy life insurance, the premium gets a little bit higher. An applicant whose birthday recently passed may wish he or she could turn the clock back and apply at that earlier date when the premium was lower. Through a process called backdating the application, also called saving age, that is possible. Most insurers allow applicants to backdate a policy application by up to 6 months. The advantage is that the premium will be slightly lower thereafter. The drawback is that applicants must pay the premium due from the backdated application date to the present. This makes sense, because coverage is made retroactive to the application's backdated effective date. Only the insurer, not the producer, can authorize the backdating of any policy application. Example. Ben, age 32, met with his agent on July 1st to purchase a life insurance policy. His birthday is March 2nd. Had he applied for the policy prior to March 2nd, he would be 1 year younger, and his premium would be less than it will be today at age 32. The insurance company Ben is applying to allows policy applications to be backdated up to 6 months. Taking advantage of this, Ben's application is backdated to March 1st. He must pay premiums from March 1st through July 1st, but the premium will be less than if the application had been dated July 1st. Premium receipts. Because it represents a key part of the applicant's consideration for the contract, paying the premium has a direct impact on when coverage becomes effective. If paid with the application, coverage may begin when the application is signed. The details of this immediate coverage are spelled out in the premium receipt given to the applicant by the producer. Premium receipts are given only when the applicant submits the first premium payment with the application. They provide interim coverage while the application is being underwritten and before the policy is issued. If a premium deposit is not paid with the application, the policy's effective date is the date the policy is delivered and the initial premium paid. There are two common types of premium receipts. Conditional receipt, binding receipt, and the closely related temporary insurance agreement. Conditional receipt. A conditional receipt provides coverage that conditionally begins when the application is signed and any required medical exams are completed. The receipt provides coverage on the condition that underwriting determines the insured to be insurable. While death benefit coverage under a conditional receipt may be provided in the amount applied for, it is not uncommon for insurers to place a maximum limit on conditional receipt death benefit amounts. Example: John applied for a $100,000 life insurance policy as a standard risk and was given a conditional receipt for that amount. 2 days after signing the application and completing a blood test, while the application was being underwritten by the insurer, John died in a car accident. Is he covered? If John was found to be a substandard risk, perhaps the medical questions and blood test showed some health risks, then coverage would not be provided. Had he lived, John would have been offered a rated policy and coverage would have begun then. As it turns out, however, the insurer's underwriter determined that John was, in fact, a standard risk. Therefore, coverage was in effect when John died, and his beneficiary will receive the $100,000 death benefit. Binding receipt. A binding receipt guarantees coverage from the time the applicant completes the application, even if the insured is later found to be uninsurable. That means coverage is guaranteed throughout the underwriting period, which can extend for several weeks, until the company rejects the application, or issues a different policy. Binding receipts are rarely permitted with life insurance. Temporary insurance agreement. An alternative to the binding receipt is the temporary insurance agreement, which is common with life insurance. To qualify for the temporary coverage, the proposed insured must be able to answer no to several medical history questions asking whether the proposed insured has been admitted to a hospital or had surgery performed or recommended within the previous 6 months, been treated for various named diseases or conditions, and/or ever had a life insurance application modified, declined, or rated. The insurance coverage provided under a temporary insurance receipt is term life insurance. Coverage normally ends 90 days following the date of application. Required signatures on the application. Every party to a life insurance policy must sign the application. It cannot be processed without all required signatures. As the proposed owner of the policy, the applicant must sign the application. In a third-party situation, where the applicant and insured are two different people, both must sign. The insured's signature grants permission to the applicant to purchase coverage on the insured's life. Producers sign the application both as witness and as agent for the insurer. Beneficiaries do not sign the application because they are not a party to the contract. Additional required documents. While the application is the starting point for underwriting, it is not always the end. Depending on the facts of the case, an insurer may require that the proposed insured complete additional questionnaires and forms dealing with medical history, hobbies, foreign travel, business beneficiaries, financial statements. Every form attached to an application must be signed and witnessed. In most cases, the producer may act as witness. Changes to the application. The application must be completed in its entirety. The application is a legal document, and part of the applicant's consideration, making accuracy critically important. If the applicant needs to change a response on the application, he or she should cross out and initial the incorrect entry and then write the correct entry next to it. Never white out and write over an incorrect entry. Key point. A producer may never, under any circumstances, change an entry made by the applicant on the application. If the producer realizes an error has been made on an application, he or she must meet with the applicant to make and initial any changes. Consequences of incomplete applications. An incomplete application can mean a delay in issuing a policy. When completing an application, producers have three important goals: accuracy, thoroughness, clarity. Because it is a legal document, the application must be clear and accurate in its facts. The goal of thoroughness does not permit the producer to coach the applicant in answering questions. The producer is expected only to record the applicant's answers, not lead the applicant to answer questions in a way that may hide important facts from the underwriter. Clarity is important. If an applicant's answer is unclear, or if an item was skipped, intentionally or not, the underwriter may return the application to the producer with instructions to obtain a clear and complete application. When a life insurance policy is issued subject to an amendment, coverage does not begin until the policy is delivered and the applicant signs the amendment. This applies even if the applicant submitted the first premium along with the application. Policy delivery. Insurance companies typically send newly issued policies to the producer for delivery to the customer. Direct response insurers send policies directly to the policy owners. While delivery by mail is permitted in most states, it is recommended that producers deliver new policies in person because it is the producer's responsibility to fully explain the policy, including any amendments or riders, and confirm it is what the customer wanted. It is an opportunity to reaffirm the customer's reasons for purchasing the policy, reducing the likelihood of policy cancellation through buyer's remorse. It is an opportunity to strengthen the client relationship. Constructive versus legal delivery. Policy delivery can occur in one of two forms, constructive or legal. Constructive delivery occurs when the insurer mails the policy to the producer responsible for delivering the policy to the policy owner with no conditions that must still be met. If any conditions are attached to delivery of the policy, then legal delivery is required. Legal delivery of a policy requires personal delivery to the client and an explanation of the conditions to be met. Delivery receipt. No matter how the policy is delivered, insurers require that the new policy owner sign a delivery receipt attesting that the policy was received. This receipt starts the free look period, typically 10 days, during which the policy owner may review the policy and, if desired, return it for a full refund. Effective date of coverage. The effective date of the policy's coverage is important for two reasons. The effective date determines when coverage begins. The effective date sets the date for annual premium payments. The effective coverage date depends on when the applicant pays the first premium. Premium submitted with application. When the initial premium is submitted with an application, the insured is entitled to a conditional receipt or a temporary insurance agreement. This receipt determines the date that coverage is effective. If the proposed insured is ultimately found to be insurable for the amount and under the terms of the policy as applied for, the effective date of coverage is the date that the application was signed. If the insured is not insurable for the coverage applied for, then the conditional receipt's coverage is not effective. Instead, the insurer may issue another policy at a new, higher, premium rate. If the applicant accepts the insurer's alternate policy, coverage becomes effective as of the date the applicant accepts the policy and pays any additional premium that may be required. Premium not submitted with application. When an application is submitted without a premium, the applicant is effectively inviting the insurer to make an offer. Accepting delivery of the policy and paying the first premium is an acceptance of the insurer's offer. The effective date of the policy's coverage will be the date the applicant pays the first premium. Statement of continued good health. If the initial premium is not paid with the application, then the applicant must sign a statement of continued good health when the policy is delivered. This assures the insurer that nothing has changed with the applicant's health that would alter the insurer's underwriting decision. If the applicant signs the statement knowing that, in fact, his or her health situation has changed since the application was submitted, the insurer has grounds to rescind the contract if this is later discovered during the policy's contestability period. Key point. A statement of continued good health is not required if the initial premium accompanied the application. Anti-money laundering activities and the USA Patriot Act. Money laundering is a serious national security concern. In its simplest form, Money laundering is the process of integrating illegally obtained money into the legal monetary system in a way that permanently hides its illegal origins. Money laundering and terrorist financing. Money laundering, which produces the largest share of funds used in terrorist activities, has come under increased scrutiny following the attacks of September 11, 2001. Transactions involving purchasing permanent, cash value, life insurance have been found to be targets of money laundering activity. Anti-money laundering refers to any activity or strategy used by law enforcement and financial officials to fight money laundering. The money laundering process. Money laundering involves a series of financial transactions that move cash or other assets from one location or form to another in such a way as to hide its origins. In the end, it makes the money appear legitimate. While there are countless variations on the theme, money laundering generally involves 3 stages. Placement, bringing the illicit cash into the financial system. Layering, using placed funds as premiums and deposits for more sophisticated financial products that provide liquidity, including permanent life insurance, with its cash value. Integration, circulating cleansed money back into the financial system. USA Patriot Act. Created after September 11, 2001, the USA Patriot Act strengthens federal enforcement in the fight on terror. Among other issues it addresses, the Act requires that all financial institutions create, execute, and maintain anti-money laundering, AML, programs. Today, every insurance company that sells certain types of life insurance and annuity contracts has an active AML program. Producers are expected to learn and follow their insurer's AML processes and procedures. For your review. Because it accounts for the cash value and policy dividends, the interest-adjusted net cost method is more widely used today than the traditional net cost method. Policy replacement is not illegal as long as it is in the customer's best interest and no misrepresentations are made by the producer. If a life insurance or annuity transaction will include replacement, the producer or insurer has a duty to inform the applicant of the potential consequences of replacing the policy. The activities a producer performs when seeking applications for insurance are called field underwriting. The application for insurance is the insurer's single most important source of information about the proposed insured. There are 2 common types of premium receipts, conditional and binding, or temporary insurance agreement. Every party to a life insurance policy must sign the application. Beneficiaries are not parties to the contract and do not sign the application. Producers may not, under any circumstances, change an entry made by the applicant on the application. Transactions involving the purchase of permanent, cash value, life insurance were found to be an important target of money laundering activity.
Policy replacement. Because few topics related to producer responsibilities evoke stronger feelings than replacement. And few issues get producers in trouble with regulators like unsuitable replacement. Now, let's be clear about one thing. Policy replacement in itself is not illegal. And in fact, there may be plenty of situations where replacing an existing policy with a new one makes sense. However, there are many more situations where the replacement of an existing policy with a new one is not in the best interest of the customer. And those are the situations that are going to get a producer in trouble. Now let's make sure we understand a couple of things. First of all, what is replacement? Replacement exists anytime an existing life insurance policy in any way is diminished in its value. That can be not only outright surrendering the policy, but converting it to any of the non-forfeiture options where the policy value is in some way reduced. Basically, it's any transaction that suspends the existing policy or reduces its value, and at the same time, a new policy is issued. Every state now has rules on the book that seek to answer the question, is the policy you're selling going to replace in any way an existing policy? If it is found that you engage in excessive replacement, you are going to be earmarked for review by the regulators. So the advice that you're going to hear is Stay away from policy replacement as a way of doing business and keep it only in place for those situations where it is truly needed.
Okay, this was a long lesson, a long video. By submitting an application for life insurance without the first premium, Larry is doing which of the following? Making the policy's effective date earlier than it would be. He is not asking for money, so that I don't think that's early. Inviting the insurer to make that offer. Negotiating for lower premiums. Maybe. We'll stick this one. I don't know. All right, which of the following? How many questions we got here? Just 4. Okay. Which of the following statements about backdating life insurance is correct? Is to qualify for better underwriting classification. Backdating is not found, but it results issuing to backdate policy. Normally, an applicant backdate up to 6 months, not 2 years. Only the insurance company, not the producer, can authorize the backdating. That might be true. I'm not sure about that. Let's go with that. All right. Which of the following statements regarding life insurance policy cost comparison methods is correct? There's a lot of information in this video. Like you, I will probably have to go back and watch it again because it was a lot of information. Okay. Cost comparison, which I don't even remember. Well, yeah, I do remember that a little bit, yeah. All right, there are 2 types. Either from being used. I don't know about that. Traditional net method, interest, and traditional is most commonly used today. There are 2 types, traditional net and interest. So which one is the most commonly used? I don't remember. I'm going to put up here this one. All of the following statements about binding receipts are correct. And I don't remember nothing about binding receipts. All right, except everything's correct. There's one thing that's wrong. Which one is it? If underwriters determine the applicant is insurable, then a binding receipt terminates coverage when that determination is right. Okay, that makes sense. This is something that's in between when the person signs the application and they are still in underwriting. That could be with the binding receipts. Do the application even though I'm insurable. Okay, I think it's this top one. Oh, everything is correct except this one. Okay. Alright. Determines a temporary insurance. Binding receipts, most common type of premium receipt used. Okay, I'm going to go with that because this is the one that's supposed to be wrong. Alright, let's see how we did. 50, we got 2 wrong. Did we get that last one wrong? No, I got it right. Okay, so all of these are correct except for this one. Binding receipts, conditional receipts, and temporary insurance agreements are the most common receipts used with life insurance applications. Okay. All right, this one up here. Delaying payment of the first premium will not influence the policy premium amount. So by delaying paying the premium, he's inviting the insurer to make an offer. Okay. But what is the offer? I guess the offer is not lower premiums. All right, which of the following about backdating is correct? I got that. Yay, I got that right. Okay, only the insurance company can authorize backdating. All right, which of the following is true? There are 2 types of the traditional cost method, interest cost method. Interest adjusted cost method is the most widely used. Okay. Because it accounts for policy cash values and dividends, the interest adjusted net cost method is more widely used than traditional, which does not recognize the interest credited by the insurer. So the interest accounts for policy cash values and dividends. That's why it is mostly used. All right, this was a 30-minute video. This was a pretty long lesson. So next one we'll be going in this series will be, I can't tell, because it might be this one. Individual underwriting by the insurer. I think that's the next one. Thanks everybody. Please subscribe.